All right, let's dive right in. Today, we are breaking down two of the most famous and maybe infamous signals in all of finance, the Golden Cross and the Death Cross.
You look at the markets on any given day, and it's just chaos, right? News, data, emotions, all of it swirling around. So how does anyone, and I mean anyone, find a clear signal in all of that noise? That's the billion-dollar question.
Well, they hunt for a pattern. They look for something that cuts through the static. And believe it or not, sometimes that signal is unbelievably simple. It's just two lines crossing on a chart, but that simple event can tell a massive story about where the market might be headed.
Okay, so let's get into how this works. To really get these signals, we have to start with the basic tool that actually creates them.
And that tool is the moving average. The best way to think about it is like a noise-canceling headphone for market data. It takes all the wild, spiky price action from day to day, averages it out, and gives you this one smooth line that shows you the real underlying trend.
So, for our story, we've got two main characters. On one hand, you have the 50-day moving average. Think of it as the hare. It's fast, it's responsive, and it captures the market's mood over the last couple of months. Then, you've got the 200-day moving average. This is the tortoise. Slow, steady, and it represents the long-term consensus view, where all the big institutional money is thinking. The real magic, well, it happens when the hare and the tortoise cross paths.
And that brings us to our first major event on the chart, the super bullish signal that everyone loves to talk about, the Golden Cross.
So here's what happens. A golden cross is that exact moment when the fast 50-day average, or hare, shoots up and crosses above the slow 200-day average. It's basically a sign that the short-term momentum is now so strong that it's actually starting to pull the whole long-term trend up with it. For a lot of traders, this is the starting gun for a brand new bull market.
But it's not just a single moment. It's more like a three-act play. First, you get the downtrend exhaustion. This is where a nasty bear market finally runs out of steam. Sellers get tired, and the price starts to find a bottom. Then, Act 2, the crossover itself. That's the big confirmation. And finally, if it's a real signal, you get Act 3, sustained ascendancy. This is where a whole new uptrend takes hold, and that 200-day line often acts as a new support level.
Okay, but does it actually work? This is where it gets really, really interesting. If you look at the S&P 500 going all the way back to 1960, a strategy where you only buy on a golden cross and sell on a death cross had a pretty amazing 79% win rate. Now, the total return was a little less than just buying and holding, sure, but look at the risk column, specifically that max drawdown.
And this is the number that matters most. The absolute worst loss, the biggest hit your portfolio would have taken with the Golden Cross strategy was minus 33%. With buy and hold, a gut-wrenching minus 56%. That is a massive, massive difference.
And that right there shows you the whole game. The Golden Cross isn't really a get-rich-quick scheme. It's a risk management tool. You might give up a little bit of the upside to potentially sidestep the absolute worst parts of a bear market. It's a trade-off.
Okay, so now let's flip the script and look at the dark side of the coin, the dreaded cousin of the Golden Cross, the Death Cross.
A death cross is the exact opposite. It's when that quick 50-day average starts to lose steam and dives below the long-term 200-day average. This is a big red flag that says the medium-term trend is so weak it's starting to drag the whole ship down with it, and a bear market could be on the horizon.
And historically, its track record has been pretty potent, but it's not perfect. It famously appeared before the huge crashes of 1929 and 2008, giving a solid warning. But in 2020, it failed big time. The COVID crash was so fast and so violent that by the time the death cross actually happened, the market had already bottomed out and was ripping higher. It just proves that this is a slow-moving indicator. It's like trying to turn an aircraft carrier. It's just not built for those sudden black swan flash crashes.
Which brings us to a really important point. The pros, they don't just see a crossover and blindly hit the buy or sell button. They use these signals as just one part of a much bigger toolkit.
See, the effectiveness of these signals totally depends on what you're trading. They tend to work great on things that have long, sustained trends, like big stock indexes or even something like Bitcoin. But if you try to use them on assets that just bounce around in a range all day, like a lot of currency pairs in the Forex market, you're going to get a ton of false signals. It'll just chop you to pieces.
And that's exactly why professionals always look for confirmation. They're asking other questions. Was that crossover backed by a huge spike in trading volume? That shows conviction. Is a momentum indicator like the RSI agreeing with the move? Or is it already way overstretched? Is another indicator, the MACD, also pointing in the same direction? They use these other tools to filter out the noise and stack the odds in their favor.
So let's put this all together. At the end of the day, we have to remember this is a tool, not a crystal ball. And the way the biggest players on Wall Street see it is maybe a little different than you'd think.
Because for a lot of the legendary macro traders out there, the real secret isn't actually the crossover event. Nope. It's all about the massive importance of just one of those lines, all by itself.
The legendary investor Paul Tudor Jones summed it up perfectly. He said, "Nothing good happens below the 200-day moving average." That's it. That one sentence is basically the entire risk management philosophy for huge institutions. The 200-day is their ultimate line in the sand.
They use it as what they call a regime filter. It's super simple. If the market is trading above its 200-day average, the light is green. The environment is risk on. But the second the market slips below that line, the light turns red. The entire environment shifts to risk off. And for them, that's a signal to pull back, play defense, and protect capital. Period.
And this chart right here is exactly why they do it. Just look at these numbers. Historically, when the S&P 500 is trading above its 200-day average, it returns an average of plus 10.8%. But when it's trading below that line, the average return is barely positive. It's just 0.31%. The difference is just staggering. It tells you that pretty much all the gains are made when you're above the line, and all the pain happens when you're below.
Which really leaves us with one final big question. In this crazy modern era of AI and algorithms that trade in microseconds, can a simple line on a chart drawn from the last 200 days of prices still have so much power? Well, the data seems to say yes. And maybe it's because so many of the biggest players are watching it that it becomes a kind of self-fulfilling prophecy, making it arguably one of the most important single lines in all of finance.